Welcome back to our YouTube channel, On the Money, powered by Allied Wealth. Matt Stevenson, president of Allied Wealth here. Today we want to continue on our series talking about investing myths and facts that many of us have heard over time. And diving right in here, we want to ask ourselves, some of these phrases we've heard over time, such as stay invested. The market always comes back, and so we've got to ride the waves of these ups and downs that we're seeing right now. And so many of the questions that we're getting in the office, people listening to our show, calling in from radio, is now the time to get out of the market? There's so much risk involved. There's no perfect time, or there's no ability to time the market perfectly. And so that's why having these conversations is so important. And looking at that in context, if we look at the S&P 500 over time, so this is a 25-year look at the stock market from the period 1980 through 2015. And we've got several lines here on the graph, but this is directly asking ourselves the question of, can we afford to miss the best days of the market and still see success that we need? Well, over that 2.5 decades of time, the stock market returned about 8.5% per year, which is pretty darn good. I'll take that. Now, if we do, in fact, miss the best days of the market, that changes things substantially. We go from an 8.5% average annual return to 3.64%. Now, maybe that's enough growth to get some of us what we need through retirement, but likely it posits some challenges, especially in the face of rising rates and inflation, such as we have today. But let's also ask the question, what if we miss the worst days of the market? That changes things considerably. We go from a 3.6% rate of return to nearly 15 every single year. Now that sounds great, but how the heck do we actually do that? And so it very much is about creating a consistent approach. Instead of missing the best days and the worst days, what if we miss both? What if we don't quite get all of the upside of the market, but we're working to mitigate a lot of the bad stuff, these drawdowns and losses that can and will happen in your nest egg to the market itself? And in that scenario, by missing the best and the worst days the market has to offer, gave us a nearly 10% average return over 25 years. And so the trick here is to aim for consistency and eliminate all these ups and downs as much as we can over the time horizon of our retirement, 20 to 30 years in a lot of cases. And so when there are negative rates of return, such as we're seeing this year, the average rate of return does not equal the actual rate of return. And so a steady rate of return will actually yield more value in your bottom line over time. So here we see on the graph, both of these lines, both of these portfolios have an 8% average rate of return over 10 years. But the portfolio that had more consistent growth to achieve that 8% return actually netted almost $400,000 more than the portfolio that had the same average rate of return, by the way, but experienced far more ups and downs as a result. This ties directly into what we call sequence of return risk. And so the timing of when you get good or bad returns, especially going into retirement, plays a huge role, especially if we're on that emotional and monetary roller coaster. Now, here we've got two examples. On the left, we have Bill and Sally. On the right, we have Tom and Alice, both retiring with a balance of $500,000 in their nest egg. Well, there on the left, unfortunately, we see that the market is pretty weak for the first 3 or so years in Bill and Sally's retirement. Compounding that issue is they need about $25,000 from the nest egg to maintain their lifestyle. Well, if we're riding the waves of the market and we're taking all this risk that it has to offer, especially in its worst years, if we see that right at the beginning of retirement, we see here that Bill and Sally's nest egg has run dry. in about 11 years' time. Because the thing that doesn't go away is your need for a paycheck replacement if you've already retired. So this ties back to some of those old adages we've heard. Just stick with it. Don't get out of the market. It always comes back. The factor that's often overlooked there is the time it takes to do so when we need these dollars the most. On the flip side of that, we've got Tom and Alice. That same $500,000 nest egg, still needing that same level of income, but here they have positive returns for the first few years of retirement instead of negative ones. And there, as we see, we're able to maintain and grow the nest egg over a long period of time. So the timing of which we see returns, if we're tied to the market, ups and downs, can play a huge role. All the more reason we need that consistency. Here's another one. It's okay if you lose money. The market always comes back, right? Well, what is the actual cost to restore your account value, your nest egg, if we see these substantial losses? So, for instance, if we look at the fourth arrow over, if we have a 50% loss, or what we call drawdown, on our nest egg, let's say that we have $1 million nest egg. We go through another 2008-09 scenario, God forbid, and we lose half of it. Well, then we've got $500,000. We actually need a 100% return to recover from a 50% loss. So our nest egg has to put forth that much more energy just to get back to where we started. Not to mention, if we're in retirement needing to lean on these dollars for income, compounding a substantial drawdown and putting us behind the 8 ball. Also understanding, we've got these mix of investments. What do we compare that set of investments to out there in the market? Maybe it's a mix of stocks and bonds. That's what we call a benchmark, our direct comparison for where our nest egg sits. And so here is an example of some of the questions we get at times. Matt, the stock market is up 15% and my portfolio is up 9%. Are you guys taking it easy over there at the office? What is going on with how my money's operating for me? And that's where it's important to understand that comparison or benchmark that we have with how your nest egg operates. And we can measure investments on a risk versus return scale. So going from bottom left, which would be most conservative, to top right, which would be most aggressive. Now, if we're on the conservative side of things, we're going to compare that mostly to the bond market. On the aggressive side of things, we're going to compare that more directly to the S&P 500, our stock market, and a blend of those anywhere in between. Now, for this client, it just so happened they were 3 notches up the scale, which is what we call a 40-60 benchmark. 40% stock, 60% bond comparison. And so we see the nightly news and we see the market's up 15%, as is this case. But the missing part of that equation is we have to understand what the bond market return is in that same scenario. And so here, if the bond market return is 5%, that blend, that 40-60 blend, gives us our benchmark. And so we can take the 15% return of the stock market multiplied by our 40% for our benchmark, and that gives us 6%. Now we take the 5% return for the bond market, multiply that by our 60% for the benchmark, that gives us the other 3. And so our benchmark return is 9%. And now we see that our portfolio is actually right in line with what it should be doing. And this all ties directly to the risk that we take with our portfolio. And we can measure the risk that we take in terms of what we call standard deviation. In a normal environment, what is the rate of change, up or down, with how my money should move in a typical year? Now, when we measure this wobble factor, if you will, we want to have a higher rate of growth or return than the risk that we're taking. For instance, if I have a portfolio that has a 15% standard deviation, and my average return is 5 for easy math example. That means that in a typical good year, it could do as much as 20. In a typical down year, it could lose as much as 10. That right there is a range of 30% in expectations, but we know that the markets rarely move more than one risk factor to the high side, but can quite often move up to 3 risk factors down, such as this year, 08-09, the dot-com crash. And so standard deviation, understanding how to hone that in, is in fact one of the most important elements to creating a successful retirement plan and getting the consistency that we need. And when we look to apply this to the clients that we see every single day in the office, we can basically break these retirees into 3 different categories. The first, what we call underfunded retirees. This is where perhaps we've got smaller investment account balances. Maybe we need to rely on Social Security, maybe TRS, a pension, something like that for a larger portion of our income, and that's okay. We also see what we call overfunded clients. These are the guys and gals that their investment assets are more than sufficient to generate the retirement income that they need and maybe not have to rely on their investments so much. But 9 times out of 10, maybe this is you listening at home, the folks that we see in the office are what we call constrained retirees. We have a limited or finite amount of resources that we need to utilize in the best way possible to maintain our lifestyle over potentially 20 to 30 years to come. And so, maybe the asset levels aren't quite as high as our overfunded retirees. A lot of these folks have done quite well in saving and building a retirement plan, but we have to look at what we call an income to asset ratio. And so if we're a constrained retiree, this is any retiree where their income to asset ratio is above 3%. So here in our example, let's say that I've got a client that needs $90,000 a year to maintain their lifestyle, and they've saved $1.5 million in the nest egg. That's a 6% ratio or withdrawal rate that we need to replace their income and maintain their lifestyle in retirement. And when we know we need 6% out of the nest egg every single year, like clockwork, the last thing we can afford to do is see these huge drawdowns, 40, 50% or more in some cases, where now that withdrawal rate is maybe 10 to 15%, compounding the loss that we've just experienced. That's why we focus so much on mitigating losses and honing in our range of expectations and what we call standard deviation, the risk that you take with your money. If you liked our content today, remember to like this video and subscribe to our channel. Matt Stevenson, President of Allied Wealth. I'll catch you next time for more videos.